Hello everyone again, Jeff here with an example of finding the return on an investment when a margin account is used. In this example, we are going to be purchasing stock for a total value of $50,000 using 60% margin. We are going to have this stock pay $200 in dividends while we are holding it. We are then going to sell the stock when its value is $60,000, making $10,000 on that part of the transaction. We are then going to pay margin interest of $300. So since we have borrowed 40% of the money in order to make this transaction, we will have to pay some interest on that, and that amount is $300. So what is our return on this investment? We find that using the formula I have hidden from you. Now, this equation may look a little complicated, but if you break it down, it's easier. ROI, return on investment, is equal to, well, what are the things coming into us? The things coming into us are the income that we earn, which in this case means the dividends, $200. What's also coming into us is the sale value of the stock, $60,000. What is going away from us is the interest we have to pay, $300, and the purchase value, $50,000. So basically this first part is the difference between the dividends that come in and the interest we have to pay out, and the second part is essentially the capital gain in the stock. We sold it for $60,000, we paid $50,000. We're going to divide all that so that we turn this into a return percentage by our equity at the purchase. So let's figure out what all of this is. First, off to the side, we want to figure out what our equity is at the purchase time. We have purchase stock with a value of $50,000, and 60% of that is our money, so 60% of it is our equity, 60% is 0.6. So our equity at the time of purchase is going to be $30,000. $30,000 of the money is ours, $20,000 is going to be borrowed. So looking at our return formula, we are going to take the income that came in, $200 in dividends, minus the interest we paid on the margin loan, $300, plus the sale value we got for the stock, $60,000, minus the amount paid for the stock, $50,000. We then take all that and divide by the amount of our money that we used to make this purchase, $30,000. That gives us 0.33 or 33%. That seems pretty good. One thing we can do now is compare that to what would have happened making the same transaction without the margin account. So in this case, our equity at purchase would be $50,000. We are not borrowing anything, so to purchase stock with a value of $50,000, we need $50,000. In this case, the income will still be the $200 worth of dividends. There is no margin loan anymore. We still sell the stock for $60,000. It was still worth $50,000 when we purchased it, and the other change is that our equity at purchase is now $50,000. We used $50,000 to make this purchase. The return on investment, 0.204 or 20.4%. What has happened here is when we used the margin, we got a higher return in percentage terms. That is because we made the same amount of money, essentially this $10,000 that the stock increased in value, but we only used $30,000 of our own money. So making $10,000 using $30,000 is a better return in percentage terms than in this example where we made $10,000 by using $50,000. So using margin essentially leverages the percentage return that you're going to get from making an investment. I should also mention, just to be responsible, that using leverage also magnifies losses if the price of this stock had gone down.